Ryan, how do I calculate the tax savings from buying a rental property? Super loaded question. There are 5 components that go into figuring this out. And by the end of today's episode, you're going to have a much better understanding of how to estimate your tax savings before you ever close on a deal. The very first and largest determinant of whether or not you're going to save a lot of money on taxes is the purchase price. Let's start with the obvious. How much you're paying for the property. This is your starting point because it's the baseline for calculating your depreciation deduction. But here's the catch. Not all of the purchase price is going to be depreciable, which brings us to the next piece. Building and land allocation. Okay. I talk about this all the time because it's super important. When you buy a piece of property, not everything's depreciable. It has to be allocated between building and it has to be allocated towards land. So you might have bought a property for $400,000, but the land's worth $100,000, and therefore your tax benefits are only going to be based on $300,000. And so you would take that $300,000 divided by 27 and a half years if it's a long-term rental, or 39 years if it's a short-term rental, and that's your depreciation deduction that you're going to get. So if it was $300,000 divided by 27 and a half, you'd get roughly about $11,000 of depreciation every year for 27 and a half years, right? Now, obviously, you can do a cost segregation to accelerate that. So in that first year, instead of only getting $11,000, you might be able to get your $300,000 basis multiplied by 25%, and maybe you're getting $80,000 in depreciation the first year, as opposed to only $11,000. We see that most of the time. Where you buy is super important, okay? If you buy in California, if you buy anywhere that borders an ocean or a lake, you can expect the land there to be worth a lot of money, okay? Now, there's a little secret too. If you buy condos and townhomes, okay, so maybe you do want to buy a property in Gulf Shores or Florida or California or New York City or wherever you want to buy it at. A lot of times you don't actually own the land that the property sits on. And therefore, all of the purchase price is normally going to be depreciable because you don't actually own the land. So when you're looking at properties, I always tell people you never buy just for the tax benefits. But if you're listening to this podcast, tax benefits are probably important to you. Now, where you buy is extremely important. The Midwest has really good tax benefits. Smoky Mountains have the best that I've ever seen. The land there's worth super cheap, next to nothing. And so you'll get a lot of tax benefits if you buy in these areas. You're not going to get a lot of tax benefits if you buy in California or anywhere where the land is worth a lot of money, especially anything that borders the ocean. So where you buy is extremely important. Here's the exercise that you want to do in order to determine the building and land breakout. And you can do this before you ever go under contract on a property. You can go look up the property's address, go find 4 to 5 comps of similar bedrooms, similar bathrooms, similar square footage that have sold within the last 12 months. And you can go and see what the breakout between building and land is, or sometimes it's called improvement value and land value. You can see that before you ever go under contract on a property or before you ever buy a property. You can go and see that online. You can go and figure out what are my estimated tax benefits going to be on this property. And you want to do that before you ever go under contract. Now, here's why you should do this exercise. Not only can you estimate how much tax benefits you'll get, but you'll also have a better idea of what your property taxes are going to increase by. You don't want to trust a realtor. You don't want to trust a seller on what the property tax bill. I'm talking about actual property taxes that you pay every single year. So go pull 4 to 5 comps that sold within the last year and see how high their property tax bill went up. If the average property tax bill after sale goes up 23%, you probably can multiply that 23% by your current property tax bill, or the property tax bill that's on the property of the current owner, and figure out how high that's going to go up. So the 2 reasons why you do this exercise: you want to know how much money you're going to save in taxes, federal income, state income taxes. And number 2, you want to figure out how high is that property tax bill going to go up? Because I've seen deals get made or broken because of how high the property tax bill is going to go up. The property makeup is also very important of a property. So this is number 3. This is where you get very strategic. If your property has a lot of stuff inside of it, which a lot of short-term rentals do, appliances, flooring, cabinets, parking lots, even outside of the property. The trick here is if you look at a property and it has a huge yard and there's stuff in that yard, like a pool, paver set, fencing, landscaping, all that stuff can be written off in the first year, and you can get 100% bonus depreciation on that. Try to find a property, do a bird's eye view of the property, and more stuff outside the house equals more tax benefits because all that stuff should be 100% depreciable. So all else being said, if you buy a property fully furnished versus a property that's vacant, you're going to get a lot more tax benefits buying a property that's fully furnished than you are a property that's going to be vacant. If this episode was helpful, take a second to share it with a fellow investor and make sure you're subscribed so you never miss a strategy to keep more of your hard-earned cash. The fourth most important thing is the taxpayer's tax bracket. So let's say you do get a $100,000 depreciation deduction by buying that rental property. What is it actually worth? Well, it depends on what tax bracket you're in. Because if you're only in a 12% tax bracket and you get $100,000 of depreciation, you're only going to save $12,000. Now, if you're in a 35% tax bracket and you have $100,000 of depreciation, well, now you're saving $35,000 in taxes. You want to make sure that you know what your tax bracket's going to be before you do a cost segregation study, because that way you actually know how much money you're going to save. And you want to take bonus depreciation in the year where you have the highest tax bracket because you will get the most benefit. So if you're listening to the podcast and you're like, Ryan, I've had these properties for 2-3 years. I just found out about cost segregation through your podcast and saving much money on taxes. What we do for our clients, and if you're interested in this, shoot us a message or go up to my website, taxstrategy365.com, because we can help. What we do is we want to look at, okay, let's say you bought a property in 2022, okay, and now it's 2025. What we're going to do is figure out what year does it benefit you the most. Does it benefit you the most in 2022, 2023, 2024, or 2025? And whatever year you have the highest tax bracket, that's the year that we want to take the cost segregation study, because it'll save you the most amount of money in taxes. We don't want to take the cost segregation study in a year that you have a low tax bracket. You won't save as much money as taking it in a year where you have a higher tax bracket. The fifth thing, and arguably the most important thing to determining how much taxes you'll save when you buy a property, is can you deduct the losses against your active income, your W-2 income, your business income? You might think, oh, great, I have this $100,000 loss, and now I can go offset anything that I want. Not really. Wrong. Unless you qualify under one of the two exceptions that I talk about in my podcast. So go back to either the real estate professional status episode or go back to the short-term rental loophole episode. A real estate professional, if you're buying a long-term rental, you or your spouse have to meet a 750-hour requirement of working in real estate, as a realtor, as an agent, doing construction. Maybe you can get there because you manage 7 or 8 properties. Like, you have to be a real estate professional in order to deduct long-term rental losses. Now, the short-term rentals have an exception. For a short-term rental, your average rental period is less than 7 days, and you materially participate. This bypasses the passive loss limitation rule, even if you're not a real estate professional. So it's which property you got? You got a long-term rental, you got a commercial property, or do you got a short-term rental property? If you got a long-term or a commercial property, you're going to have to be a real estate professional in order to deduct the losses against your active income. If you have a short-term rental property, you just have to make sure that you meet the 7-day or less average stay and you materially participate in the property. If you don't qualify under either of these, your passive losses may be suspended and carried forward until you have passive income to offset. You want to make sure that you time the huge depreciation loss with a year that you materially participate, because if not, that loss will remain passive and it gets trapped forever until you have income from the properties or you sell a property, right? So as a bonus tip, if you're doing what we call a depreciation look back, you want to make sure when we're talking about 2022, 2023, 2024, 2025, you want to make sure that you take the cost seg study in a year where you actually materially participate, because otherwise those losses are going to remain passive and they're going to be trapped forever. So let's recap the 5 major components to estimate your tax savings from buying a rental. Number 1, purchase price. Number 2, the building and land allocation. Number 3, the property makeup. What does it look like inside? What does it look like outside? Number 4, your tax bracket defines the real dollar value of your deductions. Am I in a 12% bracket? Am I in a 35% bracket? Means the entire world. We're talking about a difference of $23,000 in tax savings. Eligibility to use those losses. Can I use the loss now, or do I gotta wait till later? Okay, those 5 things. If you're buying a property this year and want to know how much it will save you in taxes, you need to model this out before you close. That's where tax planning comes in, not just tax prep. Book a call with my team to let us help you know exactly how much you're going to save on your next real estate deal. You can go to taxstrategy365.com, or I'll put a link in the description. This has been the Ryan Bakey Show. I'm Ryan Bakey, and if you want to figure out exactly how much tax benefits you can expect on your next deal, grab my deal calculator. I will post it in the link below.